Welcome to UAN Payroll 101, Level 2. In Level 2, we are going to build on the basic payroll concepts we discussed in Level 1. We discuss employees again. Who is considered an employee and who is considered an independent contractor? We'll talk about what information you need from each new employee before you can pay that employee. We'll discuss more details on earnings and more details on withholdings. Independent contractor or employee? This is a very important question, and how the entity answers it for each individual has legal ramifications for the entity. The entity will generally be liable for federal income taxes, Social Security, and Medicare, employee and employer portions, if the entity does not deduct these taxes because they incorrectly classified an employee as a non-employee. But don't fret or worry. All it takes is asking the right questions. Employees are workers at the entity, paid through payroll for their services. Taxes are deducted from their pay. They are covered by the entity's unemployment and workers' compensation plans and are often offered benefits. An independent contractor is not paid through payroll, but through accounting for the services, and they pay their own taxes and receive no benefits from the entity. Whether a worker is an employee under the Fair Labor Standards Act is a legal question determined by the working relationship between the employer and worker, not by job title or any agreement that the parties may make. So ask the following questions. Behavioral control. Is there a right to direct or control how a worker does the work? Financial control. Is there a right to direct or control the business part of the work? And relationship of the parties. How do the parties view their relationship? Let's start with behavioral control. A worker is an employee when the employer has the right to direct and control the worker. The employer does not have to actually control the way the work is done, but still holds the right to direct and control the work. For example, instructions and training. If a worker receives extensive instructions and training from the entity on how the work should be done, or required procedures and methods to do the work, then this suggests that the worker is an employee. Uniform. If a worker is required to wear a specific uniform or abide by a dress code, this suggests the worker is an employee. Working hours. If a worker is required to work certain hours by the entity, this suggests the worker is an employee. Financial control. Does the employer have the right to direct or control the business part of the work? For example, investment. Who has made a significant investment in equipment? If the worker has, then this worker may be an independent contractor. Business expense reimbursement. Is the worker reimbursed for business expenses associated with the work? If not, the worker may be an independent contractor. Profit or loss. If a worker can realize a profit or incur a loss, this suggests that the worker may be an independent contractor. Relationship of the parties. This is information that illustrates how the employer and worker perceive their relationship and how they represent their relationship to others. For example, benefits. If a worker receives benefits from the employer, such as medical insurance, pension, or paid leave, this is an indication that the worker may be an employee. Contract. A written contract may show what both the worker and the entity intend for the relationship. A contract may be significant to understanding the worker's status. And finally, permanency. If a worker is engaged with an expectation that the relationship with the entity will continue indefinitely rather than for a specific project or time period, this is generally considered evidence of the intent to create an employment relationship. Elected or appointed officials are considered employees since they are responsible to the public, who has the power to vote them out of office. There's some important reporting you should be aware of for independent contractors. First, the entity must report all workers that it classifies as independent contractors to Ohio Public Employees Retirement System, or OPERS. This requirement began after January 7, 2013. It states that within 30 days, the entity must inform the independent contractor that no contributions will be made for retirement to OPERS. The independent contractor must sign an acknowledgement of this, and the entity must send a copy to OPERS and retain the original for 5 years. Remember that an independent contractor is an individual who performs services for the entity. This is not a worker who performs services who is an employee of a corporation doing work for the entity. And the second important reporting requirement for independent contractors is that generally any payment of $600 or more in a calendar year should be reported to the independent contractor and to the IRS on Form 1099 Miscellaneous. Independent contractors are required to provide the entity with a tax identification number. This would be a Social Security number or a corporate tax ID number. The entity can use IRS Form W-9, Request for Taxpayer Identification Number, for this purpose. I heard in my younger years that we would become a paperless society. Well, I haven't seen that yet. And when you have a new employee to the entity, there is a lot of paperwork. Here is some of the information you will need from a new employee. IRS W-4, IT-4, Form I-9, a Social Security card, Ohio New Hire, OPERS enrollment, OP&FPF enrollment, SSA 1945, AOS fraud, and benefit enrollment forms. Well, okay, let's slow down and talk about each one. Now remember, all information in each employee's personnel file must be kept secure. Let's start with the W-4 form, the Employee Withholding Allowance Certificate. Yes, you see the people there? At the IRS, and they do want their money. You must have each employee complete and sign IRS Form W-4, the Employee's Withholding Allowance Certificate. This form ensures that the entity withholds the correct federal income tax from the employee's pay. The fiscal officer should not give any guidance on how to fill out the form or how many allowances the employee should declare, in case any guidance given does not result in the withholding amount the employee wanted deducted. There's no need to have employees fill out a new W-4 form each January. The employee can request a new form to fill out if their personal or financial situation has changed since the last time they filled out the form. An example of a personal situation change is if an employee has another child. They may want to add another deduction to their W-4 form. So, have you ever wondered how the W-4 form affects an employee's federal tax deductions? Well, let me tell you how. Marital status. There's a lower withholding rate for people who qualify to check the married box on the W-4 form. Everyone else must have tax withheld at the higher single rate. Some married people find that they do not have enough taxes withheld at the married rate and may choose to check the married but withhold at higher single rate. If this box is checked, the fiscal officer should withhold taxes at the higher single rate. Withholding allowances. The more allowances that the employee claims on the W-4 form, the less income tax is withheld. The employee will have the most income tax withheld by claiming 0 allowances. If an employee does not return the completed W-4 form given to them on the first day of work before the first payroll, the fiscal officer must withhold at the highest rate, single and 0 allowances. The Ohio IT-4 form, Employees Withholding Exemption Certificate. This form must be filled out and signed by every employee of the entity. It ensures that the entity withholds the correct Ohio income tax from the employee's pay. The fiscal officer should not give any guidance on how to fill out the form or how many exemptions the employee should declare in case any guidance given does not result in the withholding amount the employee wanted deducted. There is no need to have employees fill out a new IT-4 form each January. The employee can request a new form to fill out if their personal or financial situation has changed since the last time they filled out the form. I-9 Employment Eligibility Verification. Under the Immigration and Nationalities Act, employers may hire only persons who may legally work in the United States and aliens authorized to work in the United States. Employers must complete and retain Form I-9 to document verification of the identity and employment authorization of each new employee hired after November 6, 1986. The instructions for the form are specific, and we have included more details in the Payroll 101 document for you. Because immigration law and employment eligibility verification regulations can change over time, the entity should periodically check I-9 Central at U.S. Citizenship and Immigration Services for an updated I-9 information. Ohio New Hire Reporting. In 1996, Congress enacted a law called the Personal Responsibility and Work Opportunity Reconciliation Act. This was part of welfare reform. This new legislation requires that employers in all 50 states directly report their new hires to a state directory. New hire reporting accelerates the child support income withholding order process, expedites collection of child support from parents who frequently change jobs, and promptly locates non-custodial parents to help establish paternity and child support orders. Employers doing business in the state of Ohio must report new employees. They must report all employees who reside or work in the state of Ohio to whom they anticipate paying earnings. Employees must be reported even if they only work one day and are terminated prior to the employer fulfilling the new hire reporting requirement. The term newly hired employee means any employee not previously employed by the employer or who was previously employed by the employer but has been separated from such employment for at least 60 consecutive days. Entities must report contractors. This means an individual who provides services to an employer as an independent contractor for compensation. This is an individual or the sole shareholder of a corporation or the sole member of a limited liability company. Ohio Revised Code requires all employers to submit their new hire reports within 20 days after the employee is hired. Check out the Payroll 101 document for information on how to file the new hire report. Ohio Public Employees Retirement System. Employers are required to complete and submit to OPERS a personal history record for each newly hired eligible employee. The personal history record must be submitted to OPERS within 30 days of the individual's first day of employment. We will discuss much more information about OPERS in Level 3 and Level 4. Ohio Police and Fire Pension Fund. Employers must have a newly hired employee who is eligible to contribute to Ohio Police and Fire Pension Fund complete a personal history record. Once completed, the entire form must be submitted to OP&FPF and contain original signatures. OP&FPF will not accept the form if signatures have been faxed, photocopied, or scanned. We will discuss much more information about OP&FPF in Level 3 and Level 4. SSA 1945 form, or the statement concerning your employment in a job not covered by Social Security. What? Federal legislation, the Social Security Protection Act, requires state and local government employers to provide a statement to employees hired January 1st, 2005 or later in a job not covered under Social Security. This form is for public employees that are eligible for OPERS and OP&FPF. The statement explains how a pension from that job could affect future Social Security benefits to which they may become entitled. Employers must give the statement to the employee prior to the start of employment, get the employee's signature on the form, submit a copy of the signed form to pension-paying agency. Now that would be OPERS or OP&F. Copies of the SSA 1945 form are available online at the Social Security website. Auditor State Fraud Reporting. The Auditor of State has established a system for reporting of fraud, including misuse and misappropriation of public money by any public office or public official. All public employers in Ohio must provide information about the Ohio Fraud Reporting System and the means of reporting fraud to each new employee. The prescribed form from the Auditor State's Office gives the Ohio Revised Code each employer must provide and how an employee can report fraud. Each new employee has 30 days after beginning employment to confirm receipt of the information by signing and returning the form. Each public office must make all of its employees aware of the fraud reporting system after the effective date of May 4th, 2012. The public office may provide this information in the employee's handbook, and by signing the handbook, the employee would confirm receipt of the fraud reporting information. The signed acknowledgement, whether the Auditor State's form or in a handbook, must be kept in each employee's personnel file. The Auditor State will confirm, when conducting an audit, that new employees have been provided the information as required by the Ohio Revised Code. Other forms. One of those other forms could be benefit enrollment forms. Provide employees with any required enrollment forms for benefits offered by the entity. Be sure to keep copies of each benefit enrollment form, original and any updated versions, in the employee's personnel file. This protects the entity from accusations of wrongdoing on the entity's part concerning any benefits. Examples are medical insurance, dental insurance, vision insurance, life insurance, union dues, and deferred compensation. Also provide any other entity-specific forms for new employees. Check with the entity's legal counsel for any other forms that may be required. Let's start our discussion on earnings and leaves. An earning is a type of employee compensation. Remember this from Level 1? Here in Level 2, we will discuss a few earnings in more detail. Leave and compensatory time. Other taxable items. Non-retirement earnings. And non-cash benefits. The information provided here is a general discussion on earnings. Your entity may not provide all listed earning types. Consult your entity's legislation and legal counsel before using any new earning type. Leave types. Governing boards may adopt legislation to compensate certain employees for time off of work. These are a few of the possible types. Sick leave. Holiday leave. Municipal employees may use paid holiday leave for any holidays specified in adopted legislation. Township employees, per the Ohio Revised Code, are entitled to 8 hours of holiday paid leave for New Year's Day, Martin Luther King Day, Washington Lincoln Day, Memorial Day, Independence Day, Labor Day, Columbus Day, Veterans Day, Thanksgiving Day, and Christmas Day. Vacation leave. Personal leave. Administrative leave. A governing board may place an employee on administrative leave with pay. Administrative leave with pay is to be used only in circumstances where the health or safety of an employee or of any person or property entrusted to the employee's care could be adversely affected. Compensation for administrative leave with pay must be equal to the employee's base rate of pay. The length of administrative leave with pay is solely at the discretion of the entity. A governing board may place an employee on administrative leave without pay for a period not to exceed 2 months if the employee has been charged with a violation of law that is punishable as a felony. If the employee does not plead guilty to or is not found guilty of a felony with which the employee is charged, the entity must pay the employee at the employee's base rate of pay plus interest for the period the employee was on unpaid administrative leave. Comp time. Some entities may allow employees to convert overtime work to leave time off at a later date. Overtime work is converted to comp time at the same rate as the worked overtime rate. Policies on paid leave. Each entity should have written policies on all legislated paid leaves. If you don't, you may end up like this board. Well, now we know what not to do. These policies should be given to each new employee separately or contained in an employee handbook and a signed acknowledgement kept in the employee's personnel file. Auditors will consider whether governments have leave policies in place and whether the entity has historically demonstrated effective internal controls over paid leaves. They will also check if adequate training is given to employees on the proper use of paid leaves. Some additional leave policies that the entity might have are policies on unused vacation leave payout time on retirement or termination, unused sick leave payout on retirement or termination, unused personal leave annual payout, paid either by the end of each fiscal year or the beginning of the next fiscal year. This may be paid at full hours or a percentage of hours. Unused accrued sick leave annual payout, paid either by the end of each fiscal year or the beginning of the next fiscal year. This may be paid at full accrued hours or a percentage of accrued hours. Worked holiday pay. How is an employee compensated for a worked holiday? And finally, always check any collective bargaining contracts governing paid leaves. Other taxable earnings. Other taxable earnings, as the name indicates, are other earnings, not hourly, not salary, that are considered taxable by the IRS. Two examples are back pay. Back pay is treated as wages in the year paid, and employment taxes and retirement should be deducted as required. An example of back pay would be if an employee was placed on unpaid administrative leave. And when the employee returned to work, the back pay would either be board-approved back pay for the time on unpaid administrative leave because the problem was resolved that caused the unpaid leave, or the back pay is court-ordered to be paid. And the second example is leave sharing plans. If the entity has established by legislation a leave share program that allows employees to transfer their unused leave to another employee for medical emergencies, the amounts paid to the recipient of the leave are considered wages and subject to federal employment taxes, Social Security or retirement, and Medicare withholdings. Non-retirement earnings. What are non-retirement earnings? Well, they are earnings that are not included in calculating OPERS or OP&FPF. Why? Because the retirement agency said so. So, two non-retirement earnings are unused sick leave payout. And that is only if it is paid in the next fiscal year, not in the year that the leave was accrued. And second, unused vacation leave payout. And that too is only if paid in the next fiscal year, not in the year it was accrued. Non-cash benefits. A fringe benefit is a form of pay for the performance of services. The entity should have board-approved policies on all forms of non-cash benefits. Fair market value is used to determine the amount of the benefit if the benefit does not have a fixed cost. Generally, the board must determine the value of any non-cash benefits no later than January 31st each year. Non-cash benefits can be paid to the employee on each payroll, quarterly, semi-annually, or annually, but they must be paid at least annually. We will talk about two types of non-cash benefits, taxable and non-taxable. Let's talk about taxable. Non-cash benefits that are considered taxable by the IRS are paid through payroll and included in the employee's gross wages on the W-2. Some examples of taxable are the use of an entity vehicle to commute to and from work. Records of commute miles must be kept, or all of the mileage on the car is then considered taxable. Personal minutes usage on a cell phone provided by the entity, and clothing provided by the employer that is not specialty clothing, but rather clothing that can be worn by the employee for purposes other than work. Say something like steel-toed boots. Non-taxable cash benefits. Non-cash benefits that are considered not taxable by the IRS are paid through accounting, not payroll, and are not included in the employee's gross wages on the W-2. Some examples of non-cash benefits are educational assistance, the cost of group term life insurance provided by the employer up to $50,000. Any premium amount over this is taxable, less any amount that's paid by the employee. Specialty clothing, clothing that can only be used at work. And finally, an employee's car used for employer's business. but this is only if it's paid at a rate that is less than or equal to the current IRS allowable mileage rate. So check the IRS website for the current year's rate. Contact a local IRS agent if you are unsure whether a non-cash benefit is taxable or non-taxable. Also read the IRS Employer's Tax Guide to Fringe Benefits, Publication 15B. Compensation of trustees. If you are a municipality or library fiscal officer, you can ignore the next few slides. Take a breather. Township trustees are compensated on either a per diem basis, which is a paid amount for a day of service, or annual salary basis. The controlling factor for the amount of compensation is the township budget, not actual receipts and expenditures. The budget is the amount of money that the township's county budget commission certifies that the township will have available for expenditures during the fiscal year, as shown on the township's most recent amended certificate of estimated resources. For more information on the amended certificate of estimated resources, please refer to UAN training video and document fund accounting. So one type of compensation for the trustee is per diem. Whenever members of a board of township trustees are compensated by per diem and not by annual salary, the board must establish by resolution a method by which each member of the board will notify the fiscal officer before each pay period of the number of days spent in the service of the township and the kinds of services rendered on those days. The per diem compensation should be paid from the township's general fund or from other township funds in proportion to the kinds of services performed. The notice from each township trustee must be filed with the fiscal officer and preserved for inspection by any persons interested. The other type of compensation for trustees is an annual salary. The township trustee's salary are limited to 200 days a year. The amount of annual salary approved by the board should be no more than the maximum amount that could be received annually by a trustee if the trustee were paid on a per diem basis. Each trustee must certify the percentage of time spent working on matters to be paid from the township's general fund and from other township funds in proportion to the kind of services performed. If a trustee's compensation has been expended 100% from funds other than the general fund, it is very likely that the township will be subject to audit findings, and the auditors will force the township to record a fund balance adjustment that would decrease the general fund by the compensation amount, and that may jeopardize the general fund's balance. The amount of compensation varies with the township budget, as you can see in the table. The Ohio legislature fixes the per diem amount of compensation for township trustees in the biannual budget. There's more information on trustee compensation in the Payroll 101 document. Now we get to you, Township Fiscal Officer. Township fiscal officers are compensated on an annual salary basis, paid in equal monthly installments. The controlling factor for the amount of compensation is the township budget and not actual receipts and expenditures. The budget is the amount of money that the township's county budget commission certifies available for expenditure during the next fiscal year, as shown on the township's most recent amended certificate of estimated resources. A township fiscal officer may be compensated from the township general fund or from other township funds based on the proportion of time spent providing services related to each fund. Time spent working on matters other than the general business of the township must be documented, and only that time may be allocated to funds other than the general fund. Attendance at board meetings and other activities supporting the general business of the township must be allocated to the general fund. Therefore, the allocation of 100% of a fiscal officer's compensation to funds other than the general fund is not permitted under Ohio law. The amount of compensation varies with the township budget, as you can see in the table. The Ohio legislature fixes the amount of compensation for township fiscal officers in the biannual budget. Now for everyone else other than townships. The compensation for municipal officers, cities, and villages is not constrained by the budget of the entity as it is for townships. The council, through legislation, fixes the compensation of all officers, clerks, and employees of the village. The legislative authority must, in the case of elected officers, council and mayor only, fix their compensation for the ensuing term of office at a meeting held not later than 5 days prior to the last day fixed by law for filing as a candidate for such office. The compensation fixed cannot be increased or decreased during the term for which any officer is elected or appointed. Although this does not prohibit the payment of any increased costs of continuing to provide the identical benefits to an officer from the beginning of their term of office, such as yearly increases in health insurance costs. The compensation of the village clerk, treasurer, clerk treasurer, or fiscal officer is fixed through adopted legislation and may be increased or decreased during the term of office. All employees and elected officials should only be paid for their services after the services are provided. In other words, no individual should be paid at the beginning of the month before they have provided the taxpayers any service. Now we're going to talk about withholdings in more detail. In Level 1, we briefly introduced withholding types. Here in Level 2, we will go into more detail about several types of withholdings. The information provided here is a general discussion on withholdings. Your entity may not provide all listed withholding types. Consult your entity's legislation and legal counsel before using any new withholding type. We will discuss here federal income tax, Medicare, Social Security, OPERS, OP&FPF, now those are retirement withholdings, Ohio income tax, local income tax, and school district income tax, and several other miscellaneous withholding types. Now first, let's talk about federal income tax. All government entities that employ workers are subject to federal employment taxes on wages. The withheld amount is credited to the employee's individual tax account. An officer, employee, or elected official of a state or local government is an employee for income tax withholding purposes, and federal income tax must be withheld. Wages subject to federal employment taxes generally include all pay to an employee for services performed. The pay may be in cash or in other forms. Remember non-cash benefits? To know how much federal income tax to withhold from an employee's wages, the entity must have a Form W-4 on file for each employee. Part-time workers and workers hired for short periods of time are treated the same as full-time employees for federal tax withholding, and no distinction is made between classes of employees for employment tax withholding purposes, such as officers, managers, supervisors, and regular employees. Earned income credit, required notification. The entity must notify employees who have no federal income tax withheld that they may be able to claim a tax refund because of the Earned Income Credit, or EIC. The employee may not have any federal taxes withheld due to low earning levels or a high number of exemptions declared on the W-4 form. The entity can meet this notification requirement by being sure when W-2 forms are issued to the employees that they include the Earned Income Notice on the back of Copy B. The entity can also comply with the requirement by providing IRS Notice 797, which is possible federal tax refund due to the Earned Income Credit. Federal supplemental withholding. An employee may wish to have more withheld for federal income tax than is calculated by the federal tax tables. This is called a supplemental federal withholding. The employee must have entered an additional amount to withhold on their W-4 form. This supplemental amount is then withheld from each pay and submitted for payment to the IRS along with any regular federal tax withholdings. Medicare. The Federal Insurance Contributions Act, or FICA, provides for a federal system of old age survivors, disability, and hospital insurance. The hospital insurance is financed by the Medicare tax. Most employee wages are subject to Medicare tax. The entity is required to withhold Medicare from the employee's wages and pay the employer's share of these taxes. All employees are subject to the full Medicare tax rate. There are no withholding allowances to decrease Medicare tax as there are for federal income tax. For 2015, the rate for Medicare was 1.45%. Always check the IRS website for the latest Medicare rate. An officer, employee, or elected official of a state or local government is an employee for Medicare tax withholding purposes. Part-time workers and workers hired for short periods of time are treated the same as full-time employees for Medicare tax withholding, and no distinction is made between classes of employees for employment tax withholding purposes. Medicare withholdings, employee and employer share, are mandatory for any employee hired or rehired after March 31st, 1986. If you have an employee who has continually worked for the entity from before March 31st, 1986, then you do not withhold Medicare from that employee's wages. Additional Medicare tax withholding. In addition to withholding Medicare tax at 1.45%, the entity must withhold an additional 0.9% from wages paid to an employee in excess of $200,000 in a calendar year. Now, no giggling out there. The additional tax must be withheld in the pay period in which the employee's gross wages are in excess of $200,000 and continue to withhold it each pay period until the end of the year. Additional Medicare tax is only imposed on the employee. There is no employer share of this tax. Social Security. Most public employees of Ohio contribute to a state-sponsored retirement program, such as OPERS or OP&FPF, and do not contribute to Social Security. As fiscal officer, you must know which employees contribute to a state-sponsored retirement program and which employees, if any, contribute to Social Security. You want to be sure of this because it can be quite a mess trying to fix retirement withholdings submitted to the wrong retirement agency. The Federal Tax Insurance Contributions Act, or FICA, provides for a federal system of old age, survivors, disability, and hospital insurance. The old age, survivors, and disability insurance is financed by Social Security. For 2015, the Social Security tax rate is 6.2%, each for the employee and the employer portion. Always check the IRS website for the most current Social Security rate. The wage-based limit which is the maximum wage subject to tax for the year, is $118,500 in 2015. There's no withholding allowances to decrease Social Security tax as there are for federal income tax. Part-time workers and workers hired for short periods of time are treated the same as full-time workers for Social Security tax withholding, and no distinction is made between classes of employees for withholding purposes. An employee's Social Security number is used for posting and maintaining the earnings and employment records of persons covered under Social Security program. Employers withhold Social Security taxes from the employee's paychecks, and with the employer portion, deposit the amounts with the IRS. When a worker or a worker's family member applies for Social Security benefits, the worker's earnings record is used to determine the eligibility for benefits and the amount of any cash benefits payable. This is why it is crucial for the entity to maintain accurate payroll records, up-to-date Social Security number information, and make timely deposits of both employee and employer tax so that each employee's earnings are correctly posted to that employee's Social Security earnings record. Beginning in 1951, states were allowed to enter into voluntary agreements with the federal government to provide Social Security coverage to public employees, such as OPERS and OP&FPF. But some exceptions are elected officials. An elected official at the beginning of their term may choose to contribute to Ohio Public Employees Retirement System or to Social Security. Once an official has elected to contribute to OPERS, the official must continue to contribute to OPERS. If an official chooses to contribute to Social Security at the beginning of their term, they can at any time instead elect to contribute to OPERS. Per item compensated employees. Employees compensated on a per item basis must contribute to Social Security. They may not elect to contribute to OPERS. Examples of per item compensation are trustees, council, or board members who are paid per meeting, a zoning inspector who is paid per permit or per inspection, and finally, volunteer firemen. Ohio Administrative Code states that effective May 1st, 1991, a volunteer firefighter is not a public employee and shall not be a member of the retirement system, and therefore should contribute to Social Security. Ohio Public Employees Retirement System and Ohio Police and Fire Pension Fund. Beginning in 1951, states were allowed to enter into voluntary agreements with the federal government to provide Social Security coverage to public employees, such as OPERS and OP&FPF. Effective July 2nd, 1991, Congress made Social Security coverage mandatory for state and local government employees who are not qualified participants in a public retirement system. A public retirement system is a pension, annuity, or retirement system maintained by a state government that provides retirement benefit to the employee that is comparable to the benefit provided under Social Security. We will discuss OPERS and OP&FPF individually in greater detail in Level 3. Ohio income tax. Every employer maintaining an office or transacting business within the state of Ohio and making payment of any compensation to an employee, whether resident or non-resident, must withhold Ohio income tax. Some exceptions are residents of Michigan, Indiana, Kentucky, West Virginia, and Pennsylvania due to reciprocal agreements with Ohio. Wages subject to Ohio income taxes generally include all pay to an employee for services performed. The pay may be in cash or in other forms. An officer or elected official of a state, or local government is an employee for income tax withholding purposes. Part-time workers and workers hired for a short period of time are treated the same as full-time workers for Ohio income tax withholding. No distinction is made between classes of employees. To know how much Ohio income tax to withhold from an employee's wages, the entity must have an Ohio Form IT-4 on file for each employee. If an employee has not returned a completed IT-4 form before the first pay, the fiscal officer must withhold Ohio income tax from the employee's compensation without any exemptions included. Ohio supplemental. An employee may wish to have more withheld for Ohio income tax than is calculated by the Ohio tax tables. This is called a supplemental Ohio withholding. The employee must have entered an additional amount to withhold on their I-2-4 form. This supplemental amount is then withheld from each pay and submitted for payment to the Ohio Department of Taxation, along with any regular Ohio tax withholdings. The entity is liable for tax required to be withheld from the employee's compensation. Amounts required to be withheld and paid to the Ohio Department of Taxation are considered to be a tax on the employer. The officer or the employee having control or supervision of or charged with the responsibility of filing the report and making payment will be held personally liable for any failure to report and pay the tax as required by law. Yikes! Remember to pay your Ohio income taxes. Every employer required to withhold Ohio income tax is also required to maintain accurate records of all persons from whom the tax is collected for a period of 4 years from the tax due date. Records must include amounts and dates of all compensation paid and taxes withheld by pay period, names, addresses, and Social Security numbers of all employees receiving compensation, periods of employment, including periods during which compensation is paid while absent due to sickness or injury, and entities must keep copies of all forms filed with the Ohio Department of Taxation. Local income tax. This tax is paid by residents of a city or village that has imposed or levied a municipal income tax. The tax generally applies to wages, salaries, and other compensation earned. Personal exemptions are not granted for local income tax, as used for federal and state income tax. The tax is also paid by non-residents who work in the municipality. In 2009, 577 municipalities, 236 cities, and 341 villages had a levied municipal income tax. The fiscal officer must ask each new employee if they live in a municipality with a levied income tax, and if they know the income tax rate so that it can be withheld and paid to the municipality for the employee. Multiple local taxes can be set up in UAN because an employee may have a local income tax withholding for where they work and where they live. Local school district income tax. Ohio law requires the entity to ask each employee for the school district in which they reside. The employer's office or the employee's work location is irrelevant. The employee's residence is the determining factor for employers to withhold school district income tax. An employee would only ever have one school district income tax withholding. If the employee lives in a school district with a school district income tax in effect, then you must withhold this tax from the employee's compensation. Employers not fulfilling these requirements are subject to penalties and interest for any unpaid school district income taxes, even if the taxes were not withheld from the employee. The officer or the employee having control or supervision of or charged with the responsibility of filing reports and making the payment for any school district income taxes will be held personally liable for any failure to do so as required by law. Wages subject to school district income tax generally include all pay to an employee for services performed. The pay may be in cash or in other forms. Employers should use the same number of personal exemptions that are used for withholding Ohio income tax from the IT-4 form and use the school district tax withholding tables. UAN does this for you. Remember that personal exemptions impact how much is deducted from an employee's wages. So, a 1% school income tax will not necessarily deduct 1% of gross wages. Several school districts have enacted an alternative earned income only tax base. For these school districts, employers should withhold at a flat rate equal to the tax rate for the school district with no reduction or adjustment for personal exemptions from the Ohio IT-4 form. There's a list of school districts that have enacted earned income only tax base on the Ohio Department of Taxation website. Every employer must keep on file Ohio Form IT-4, Employees Withholding Exemption Certificate, and employees must update the form whenever any information changes. Cafeteria plan deductions. What is a cafeteria plan? Free food? No. A cafeteria plan is a separate written plan maintained by an employer for employees that meets the specific requirements of and regulations of Section 125 of the Internal Revenue Code. It provides participants an opportunity to receive certain benefits on a pre-tax basis, which means the amount of benefit deduction is subtracted from an employee's gross earnings before certain taxes are calculated. Qualified benefits include but are not limited to the following: accident and health benefits, employee share of the premium; COBRA, disability coverage, short-term and long-term, fully employee paid; group term life insurance coverage, fully employee paid premium, only up to $50,000 coverage. Any amount over $50,000, the portion of that premium is taxable. Health savings accounts, only employee contribution. The written plan must specifically describe all benefits and establish rules for eligibility and elections. A Section 125 plan is the only means by which an employer can offer employees a choice between taxable and non-taxable benefits. For example, employees covered under the entity's group health plan pay 15% of the premium through payroll deduction. A valid Section 125 plan is the only way that this deduction can be pre-tax. Pre-tax means that employees' gross earnings are reduced by the amount of the health premium deduction before taxes are calculated. That's only for federal, Medicare, Social Security, local income tax, and school district income tax. The entity should have authorization for deduction. Now, the entity may deduct from an employee's compensation the cost for one or more qualified benefits under a cafeteria plan if the employee authorizes in writing that the entity can deduct a specific amount for a specific qualified benefit and authorizes the entity to pay the program administrators on the employee's behalf. The benefit must be offered to all employees on a group basis, and at least 10% of the entity employees voluntarily elect to participate in a specific qualified benefit. Deferred compensation program. What is it? It is an amount of earned income that is payable at a later date. Okay. Why would I want that? Most deferred compensation plans allow the wage earner to defer tax now so that the funds can be withdrawn and taxed at some point in the future, except for Medicare, Social Security, and local income tax. The most common form of deferred compensation is a retirement plan. Deferred income allows the earner to use the income later in life when they have a lower tax rate. Other examples include pension plans and stock option plans. Ohio Public Employees Retirement System offers a deferred compensation program for public employees. The deferred compensation is in addition to the employee's regular retirement program deductions. All public entities must provide employees with the informational material from OPERS. Any employee interested in the program may complete program materials and return them to the fiscal officer to submit to OPERS. OPERS will notify the entity of the first payroll deduction amount and the date for any employee wishing to participate in the program. Any income deferred under such programs is still included as regular compensation for the purpose of calculating the contributions and benefits from the retirement system for each employees, OPERS or OP&F. Any deferred compensation is still reported as income for the purpose of child support or divorce settlement, but may not be subject to the execution of garnishment or bankruptcy. Other miscellaneous deductions. Some examples of other miscellaneous deductions are child support. Court-authorized child support must be deducted from the employee's pay in the required amount and as directed in the court documents. If the employee receives any new or unusual earnings, the fiscal officer should consult the court documents or call the child support agency to confirm if child support should be deducted from such earnings. Do not take the word of the employee about this. Wage garnishment. Court-authorized wage garnishment must be deducted from the employee's pay in the required amount and as directed in the court documents. Title III of the Consumer Credit Protection Act protects employees by limiting the amount of earnings that may be garnished in any work week or pay period. If the employee receives any new or unusual earnings, the fiscal officer should consult the court documents or call the garnishment agency to confirm if the garnishment should be deducted from such earnings. Do not take the word of the employee about this. Insurances. Employee authorized insurance deductions. This can include employee portion of health insurance premium, dental, vision, extra life insurance coverage, health and wellness insurance such as AFLAC, short and long-term disability, union dues, and charitable deductions. See the Ohio Revised Code for guidance on charitable deductions. Remember to watch for withholding rate changes during the year so that the proper rates for all withholdings are deducted at the proper time for all employees. This concludes Level 2. In this level, we discussed more about employees, classifications, is an employee or an independent contractor, and about important reporting requirements for independent contractors. We talked about a bunch of paperwork you need for each employee. We talked about specific types of earnings your entity may have, such as leaves, other taxable earnings, non-retirement earnings, and non-cash benefits, and about several different types of withholdings. This concludes Level 2 of Payroll 101. Thank you.